There is no inflation today. As a matter of fact, we saw the best inflation numbers since 2020. So there has been nothing passed on. There has been no tariff recession. So no inflation, no recession due to tariffs.
US is suffering from inflation and causing rising prices for its consumers. China, on the other hand, is facing an outbreak from inflation and they are getting into recession, and the prices of goods in China are getting more better and more favorable for their consumers. The world is teetering on the edge of a full-blown collapse. With crisis after crisis spilling up, recent development involving Iran has forced US to re-evaluate its entire tariff landscape. The situation has drastically shifted. Although the US may appear shielded from the immediate fallout, inflation is becoming a serious concern, especially due to the recent exchange of strikes between Israel and Iran. One of the more critical incidents was the attack on Iran's South Power gas field, which is the world's largest, which has now ceased the production of 12 million cubic meters of gas per day. Hello everyone, welcome back to the channel. If you've not yet, please subscribe and click the notification bell for more upcoming updates on the US and China trade war and how the war between Israel and Iran has not only affected both parties but has also caused a high level of inflation in the US economy, thereby giving China the upper hand.
Things have escalated further. Two more essential energy infrastructures, including Tehran's main gas storage and a central oil refinery, were hit by Israeli forces. These developments are highly dangerous and precisely the kind of energy-targeted conflict we feared from the beginning. If Iran retaliates by hitting key OPEC infrastructure or blocking vital transit routes, it could spiral into a broader regional crisis. What does this mean economically? A surge in inflation for the US, just as we were hoping for stability. JP Morgan is already warning of a worst-case scenario where crude oil spikes to $130.00 per barrel, double the price from just a week ago. This would push US inflation up to 5%, also nearly double the current rate. This inflationary pressure throws the US trade war strategy into jeopardy. The Federal Reserve, already hesitant to lower interest rates, may be completely paralyzed now. Core inflation data from May shows stubbornly high numbers, around 3% for core CPI, 4% for services, and a rebound in goods inflation, all before these Middle East developments even hit the headlines. Higher energy costs will filter through the economy, first hitting gas and groceries, then everything else. In this climate, continuing the tariff war would be political and economic suicide, yet some officials continue to deny the reality of tariffs as consumer taxes, even though official trade sources clearly describe them as such. July 8 is a key date. The current pause on new tariffs is set to expire, and without further delays, we could see inflation soar even more. Besson, presumably a government figure here, has hinted at extending this pause for good faith negotiations, but odds are it will be widened to cover more key trading partners. The steep tariffs on China, however, are expected to remain. The consequences are already visible. US consumers are facing steep price increases on Chinese imports, and American importers are under strain. In May alone, the Port of Los Angeles saw a nearly 20% drop in imports from Asia. That same month, US Customs collected over $23 billion, 0 cents, in tariffs, essentially another cost passed to the consumer. If oil prices continue to rise, the cost of domestic production in the US will also climb due to energy and labor expenses. This adds more inflationary fuel to the fire. Returning to previous tariff levels would be catastrophic under current conditions. Just 2 months ago, US trade reps were boasting about an influx of deals, but only the UK agreement and a temporary truce with China have materialized, with minimal impact. With inflation now flaring up, more delays in tariff plans are likely, especially with little diplomatic progress in the Middle East. Iranian lawmakers have already threatened to close the Strait of Hormuz, which could worsen the energy crisis. Meanwhile, the Fed is stuck. It can't cut interest rates with inflation rebounding, making borrowing more expensive for the US government. Besson, aware of the growing fiscal threat, is now repositioning himself as a budget hawk, claiming he'll reduce the deficit to GDP ratio below 4% by the end of Trump's term. On the surface, that sounds responsible, but the reality is more complex. The government is still expected to run significant deficits. According to the CBO, by 2028, the US will still be running a deficit north of 6%. So how does Besson plan to hit that 4% target? Through financial manipulation, inflating GDP so the ratio looks better without actually reducing spending. The math is simple. If the US borrows $2 trillion, 0 cents, annually, and GDP doubles to $50 trillion, 0 cents, through inflation, the ratio magically shrinks to 4%, even though the spending stays the same. This tactic only works by juicing the economy through aggressive fiscal policy and relying on a more inflation-tolerant Fed, likely with a new, more compliant chair once Powell is out. Analysts like Luke Groman are already flagging this shift toward financial repression, pushing inflation higher while keeping interest rates artificially low, effectively forcing investors and banks to buy government debt that yields less than the rate of inflation. This tactic reduces the real cost of debt, but punishes savers and bondholders. Oil is already up 8–10%, and if crude keeps climbing, the Fed's hands will be tied. No rate cuts, no relief, and Wall Street is bracing for it. Traders like Paul Tudor Jones expect the dollar to fall another 10%. Others, like Jeff Gundlach, predict yields could rise to 6% on 30-year bonds, something the Fed might have to fight to avoid a full-blown crisis. As for foreign policy, the Trump administration's messaging has been inconsistent. One moment, Trump suggests he had prior knowledge of the Israeli strikes. The next, he denies US involvement. Iran is clearly not buying it. They've already pulled out of nuclear talks and dismissed any deal-making. Trump still believes he can negotiate peace between Iran and Israel, as he did with other regional players during his first term. But the current environment is far more volatile, and his rhetoric feels increasingly detached from reality.
In the end, this chaos could leave US with fewer options, a weaker economy, and diminishing global leverage. Whether we are heading towards a minor inflation spike or a full-scale recession, it will depend on how this event unfolds. Let me know your thoughts in the comment section. Is what Besson saying right? Don't forget to like, comment, share, and subscribe this video for more upcoming updates.